gentlemen, good day and welcome to the Thyrocare Q2 FY26 earnings call hosted by Thyrocare Technologies Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Preet Joshi from Thyrocare. Thank you, and over to you, Mr. Joshi.
Thank you, Darwin. A very good evening to all. Earnings conference call for the second quarter of FY2026. Today we have with us Mr. Rahul Guha, MD and CEO of Thyrocare, Mr. Vikram Gupta, CFO of Thyrocare, along with other key members of the senior management on this call to share the highlights of the business and financials for the quarter results. I hope you have gone through our results release, the quarterly earnings presentation, and the press release, which has now been uploaded on the stock exchange website. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to the risk pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Mr. Rahul Guha to make the opening remarks. Over to you, Rahul.
Thank you, Preet. Good evening and welcome to all on the call. Thank you for taking out time from your busy schedules to join us this evening. Just a quick introduction to us on the call. My name is Rahul Guha and I'm the MD and CEO of Thyrocare, and thank you for the opportunity to present the Q2 results for FY26. I'm joined with my colleague Vikram Gupta, who is our CFO, and Preet Joshi, who is a part of our strategy and investor relations team, along with other key members of the senior management. To commemorate the 25th year of Thyrocare since its incorporation, and in line with the forthcoming auspicious celebrations of Diwali, it gives me great pleasure to announce the following. Bonus shares. The Board of Directors have approved issuance of bonus shares in the proportion of 2:1, that is 2 bonus equity shares of rupees 10 each for every 1 fully paid up equity share held as on the record date. This is subject to statutory and regulatory approvals as applicable. The bonus issue underscores our consistent performance over the years. It's important to note our non-COVID growth over the last 4 years has been 19% CAGR, and this reflects our confidence in the company's future growth strategy and reaffirms our commitment to reward our shareholders and investors. It also aims to enhance liquidity in the stock and expand retail participation. Along with the bonus issue, we are very pleased to announce an interim dividend. Board of Directors has declared an interim dividend of rupees 7 per equity share of the face value of rupees 10 each, pre-bonus issuance. Record date for the interim dividend payout will be considered 24th October 2025. With these two announcements, we wish our shareholders a very wonderful and happy Diwali. Now coming to the business. As in all my calls, I will start with a quote from Nelson Mandela in recognition of our foray into Africa. It is in your hands to make a better world for all who live in it. We believe Thyrocare can bring our business model to Africa to make affordable and good quality diagnostics accessible to all. Before we get into the details of this quarter, it has now been 2 years since we implemented the pay-for-performance structure, which has led to renewed energy and motivation within our franchise network to move up volumes and enter higher slabs. I am happy to report that our franchisee base is at its highest ever, with steady growth over the last 2 years. Encouraged by this success, we have expanded both field and central teams to accelerate franchisee addition. This has enabled us to go deeper into India and open highly transacting stores at a much faster pace. Our new activation strategy has been delivering encouraging results. By engaging local partners and improving conversion efficiency, we are now seeing consistent growth in sample volumes and new customer addition. We continue to expand deeper into Tier 3 cities and beyond, where we see strong long-term potential. To support this, we have made strategic investments in logistics and network capabilities, ensuring faster turnaround and better service reach. As of Q2 FY26, we have 10,100 plus active quarterly franchisees, compared to 8,446 in the same quarter last year and 9,413 in the last quarter. Our pace of franchise expansion has picked up meaningfully, supported by renewed partner interest, strong brand equity, and our tech-driven support model. Quality as a core focus remains our highest priority. It's a continuous journey of improvement and innovation. Last year, we became India's first and only 100% NABL accredited national laboratory chain, a prestigious milestone reflecting our commitment to world-class diagnostics and excellence. Achieving NABL accreditation across all labs was possible through robust quality management systems, advanced technology, rigorous training, and proficiency testing. Given that only 2% of pathology labs in India hold this accreditation, this achievement underscores our leadership in redefining diagnostic standards. But that is not enough. We have now set a target of achieving 6 Sigma level quality, tracking complaints per million with a goal to bring it down below 3.4 per million. We've made tremendous progress, improving from 11.8 in Q2 FY25 last year to 3.8 this quarter, positioning us to soon become the first lab chain to achieve 6 Sigma standards in diagnostics. On innovation and research, we conducted and published India's largest HbA1c study, analyzing 20 lakh results to provide deep insights into national diabetes trends. We also launched our fever study based on data from our Janch fever panels, which revealed that 1 in 3 fevers are more complex infections such as dengue, typhoid, malaria, and influenza, reinforcing the need for timely testing and treatment. In the last few quarters, we've added multiple advanced technologies, including histopathology, a new HPLC platform, coagulation, and the BioFire PCR platform. On operational efficiency, while maintaining the highest quality standards, we continue to improve turnaround time. During Q2 FY26, we released reports within 3.52 hours on average after samples reach the lab, made possible by robust processes, automation, and streamlined workflows. We have fully integrated the Polo and Vimta networks and gone live with ECG at home services via ThinkHealth. Our lab network now stands at 37 labs in India and 1 in Tanzania. We are also expanding our test menu and offering. Our flagship brand, Arogyam, continues to lead the preventive healthcare segment, growing at 19% year-on-year, complemented by Janch, which caters to lifestyle and chronic health needs and has grown 31% year-on-year and is becoming a strong pillar of our lifestyle offering. On the business and market insights, fever-related volumes were muted this season, actually down 26% versus the same quarter last year. reflecting tremendous work by various government agencies to control viral vectors. But our core business remains stable, demonstrating resilience and customer trust. Our partnerships business performed exceptionally well, onboarding new health tech clients and growing existing accounts. On the B2G side, we continue to execute TB projects in Gujarat and Maharashtra. In Tanzania, our business, though nascent, grew 30% quarter on quarter and is expected to double revenues this year and achieve operating break-even in 18 to 24 months. Thus, our three pillars of growth, customer success, network expansion, and menu expansion, continue to be the key drivers of our consistent performance, reinforcing our focus on operational excellence, franchisee growth, and continuous innovation to deliver long-term value. Now, I will briefly update you about the business performance in Q2 FY26. We processed 53.3 million tests, up 21% year-on-year, and served 5 million patients, a 12% year-on-year increase. Overall, at a consolidated level, this quarter, we did a 22% year-on-year revenue growth, primarily driven by our pathology business, with a growth of 24% year-on-year. Our franchisee business for the quarter showed a revenue growth of 20% year-on-year in Q2 FY26. Revenue per retained franchisee has been consistently growing for the franchisees added post FY22. This has been possible because of our slab-based pricing model, improved quality, and strengthening of our relationship with doctors and channel partners, along with test menu expansion. Our partnerships business in the quarter showed a tremendous growth of 35%, and our API pharmacy diagnostics business this quarter grew by 36% year-on-year. Radiology businesses active centers did a modest revenue growth of 3% year-on-year this quarter, but improved their profitability dramatically. With that, I will hand over to my colleague Vikram to cover the financial results.
Thank you, Rahul, and welcome to everyone joining us today. I am pleased to report that we delivered another quarter of strong financial performance, driven by consistent revenue growth and continued improvement in operational efficiency. This reinforces our commitment to long-term value creation for our shareholders and investors. Thyrocare has been consistently delivering high teen to early 20% growth over recent quarters and outperformed the pathology diagnostic industry, which is growing at an early to mid-teen rates. In reality, this performance can be seen consistently over the last 2 years, but was not reflecting because of COVID and API degrowth. Now that COVID is out of base and API has come back on the growth track, the overall numbers are reflective of this upswing. This sustained performance reflects not only the strength of our business model, but also our ability to execute in a dynamic and competitive environment. Before we discuss the finances, let me briefly touch upon our employee stock option plan. As the Thyrocare ESOP program concludes and we have only limited pool of Thyrocare shares remaining, our parent company has decided to expand the API ESOP pool to include Thyrocare senior management. This group-level initiative is aimed at retaining critical talent at Thyrocare level. ESOP will be issued as per the parent company and will vest in accordance with the established policy. From an accounting standpoint, these ESOPs are recognized as an expense in the profit and loss account and as an equity contribution from the parent in the balance sheet. It is important to note that this is a non-cash charge and does not impact our cash flow. To enhance clarity, we report normalized EBITDA by excluding these non-cash expenses also and have included an annexure in our quarterly earning presentation to further explain the accounting treatment. Now, let me take you through few of the financial highlights of the current quarter. On the revenue side, standalone revenue for the quarter first time close to rupees 200 crore. This is the highest ever revenue we have done on a standalone basis at Thyrocare, which is a year-on-year growth of 24%, driven by a 20% growth in franchisee business and 35% growth in partnership business. Radiology active sector business grew marginally, but this is in line with our focus on that business to drive profitable growth, enhance margin, and optimize overhead to improve the overall performance. Consolidated revenue is highest ever at 217 crores, which is a robust year-on-year growth of 22%. On margin and profitability, the standalone gross margin is at 71.6%, up by 100 basis points YOY. This is mainly due to operational efficiencies, favorable product mix, and negotiations. Standalone normalized EBITDA margin is at 36%, which is an improvement of 470 basis points versus last year. This is largely benefiting from better gross margin, operating leverage, and better recovery. At the consolidated level, consolidated gross margin stood at 72%, with normalized EBITDA margin at 34.8%. Consolidated normalized EBITDA grew by 49%, while PAT saw YOY growth of 82%. Earning per share for Q2 FY26 came in at rupees 9.05, which is again 82% up from the same period last year, which was at 4.99. On the balance sheet, we continues to be very strong and resilient. The company is debt-free and on a consolidated basis holds a net cash and cash equivalents, including short-term mutual funds of rupees 190 crore plus. In cash flow, in H126, we generated rupees 127 crore cash flow from operating activities. This is higher by rupees 38 crore versus last year, which is a year-on-year growth of 43% over H1 FY25. So this was on the financial performance. Lastly, as covered by Rahul, in line with strong financial performance and Silver Jubilee celebration of Thyrocare, the Board of Directors has approved a bonus issue in the ratio of 2:1. This is subject to statutory and regulatory approvals as applicable. The record date will be communicated shortly through our stock exchange filings. It is important to note that this bonus issue will be made entirely from our free reserves and will not impact the company cash position. Further, Board of Directors had declared an interim dividend of rupees 7 per equity share. The record date of the interim dividend is 24th October 2005. As covered above, the company is having sufficient cash and cash equivalent reserves for paying dividend as well as to invest into business expansion. With that, now I hand over to Rahul for the strategic updates.
Thank you, Vikram. Briefly, I would like to take a few minutes to recap to you our strategic direction, and then I will open it up for Q&A. First, I will reiterate our value proposition to the customer. We will continue to remain an affordable option to all patients with good quality and on-time reports. All our efforts on our value proposition is towards ensuring low cost to the patient, assurance on quality of testing through our certifications and engagement with doctors. We have made substantial progress on this, which I updated in my initial comments and is reflected in the presentation. This will remain at our core and will continue to guide all that we will do. Second, our strategy. We continue to maintain our strategy of being the B2B partner of choice to all front-end diagnostic services companies in India. Whether it is a small diagnostic center in a semi-urban area, a pharmacy in a metro, a small nursing home, an individual doctor, or a leading online diagnostic platform or health tech marketplace. We are happy to work with them to provide low-cost, robust testing solutions so that they can serve their patients in the most effective manner. If they require phlebotomy, we are happy to mobilize our company-owned phlebotomy network of almost 1,900 phlebotomists, including our network partners, to serve them better. We remain dedicated to expanding our business And with the expansion of Polo Labs and Vimta Clinical Diagnostics, we plan to significantly increase our presence in North and South India respectively. Additionally, to further boost our partnerships business, the acquisition of ThinkHealth has allowed us to scale ECG at home services and enter the high-growth pre-policy medical checkup business, further enhancing our value to our insurance partners. This strategy has been working well for us, with both our franchisee and partnerships businesses posting strong growth. That, in a brief, is our mandate as management. Thank you for giving us a patient hearing. I will once again end with a quote from the Mahatma: "Find purpose, the means will follow, and our purpose remains to provide affordable, high-quality testing to the masses." With that, we'll open it up for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Siddhant K, an individual investor. Please go ahead.
Yeah. Good evening, sir. So thank you for the opportunity. So my question is basically I've just started following Thyrocare. So I just wanted some clarity on the business model. So when we talk about the franchise model, we are talking about the collection centers, which is under our own brand, right? But, hello, am I audible?
Sir, you are audible. You may proceed.
Can you finish your whole question, then I will answer.
Yeah, sure, sir. So when we talk about the franchise model, we are talking about the collection center which are under our own brand. So, sir, just wanted to understand, do we send the phlebotomist? The phlebotomist is under our payroll or on the franchise balance sheet? And my second question is, sir, what will be the revenue split between our brand versus non-brand? Basically, the third-party hospitals or the diagnostic centers which are not under the Thyrocare brand.
Understood. So, firstly, just to explain the business model, our franchisees can be a hospital, a nursing home, a standalone pathology lab, or a collection center, right? So all four of these any one of these could be our franchisees. Some of them are branded, some of them are unbranded, right? The rough split is about, I would say, of the 10,000 franchisees, probably around 1,000 would be fully Thyrocare branded, which means that they have a Thyrocare board, Thyrocare livery, and all of that. And the remaining will be unbranded or not Thyrocare branded, maybe a hospital, maybe a nursing home, maybe a standalone doctor, maybe a collection center, or even a standalone pathology lab. So that's the rough mix of the footprint. In all cases, the report is a Thyrocare report, whether they are branded or unbranded. At the end of the day, the report that is handed over is a Thyrocare report. Now, coming to the split, while 1,000 would be branded, 1,000 out of the 10,000, that 1,000 will account for about 40% of our revenue. So that's the revenue split, while I give you the count split. We have a separate phlebotomy fleet that is not included in our franchisees. This is what I call the Thyrocare phlebotomy fleet. This is, in my opening comments, I mentioned 1,900 phlebotomists that work with us. These are largely to service our partnership business. We are the only company, at least in my understanding, that has a dedicated company fleet that services corporate partnerships, health tech orders. And that allows us to differentiate because we don't route these orders to the franchise network. We execute it with our own phlebotomy fleet.
Right, sir. So thank you for such a detailed answer. Yeah, so just one more question. So when we talk about the 40% revenue which is coming from those 1,000 centers, so then is it safe to assume that those 40% revenue is actually D2C revenue only and not a B2B revenue?
See, we don't differentiate that way. For us, all reports are a Thyrocare report. So in that way, a Thyrocare branded report is reaching the patient's hand. So we look at it that way.
Okay, but is there some element of B2B in those 40% also?
There would be, but not a large component.
Okay, sir. Okay. Thank you so much, sir. I'll get back in the queue.
Thank you. Our next question comes from the line of Bhavya Nahar from Tamohara Investment Managers. Please go ahead.
Hi, sir. Good evening. So a few quarters ago, we spoke of our franchise network being revamped with the new tiered incentive structure, and we streamlined our entire franchise network down to 7,000 franchisees, and today we are at 10,000 franchisees. So the growth in revenue from franchise business seems slowly driven by growth in number of partners. So with no throughput growth, are we worried of the reverse phenomenon happening?
Actually, that's not true. Actually, if you see our overall growth, has largely been driven by what we call the diamond to silver category partners, our large partners. So if you look at our mix, we had said about 10,000. It's half and half diamond to silver and half bronze and below, right? That's how we bifurcate the list. Actually, most of the growth has come from the diamond to silver, both from a count as well as revenue, right? So I would say we've been able to add a lot of large partners, and they have grown very well with us.
And so also the gross margin increase as the incentives we dole out are lower. So will that also be the reason behind the gross margin increase? Or?
No, I'll let Vikram comment a little bit, but it is my understanding that the gross margin has not come because of price, but for better negotiation. But Vikram, you can give more detail.
So as an affordable player, actually we don't believe in increasing the prices. So most of the gross margin improvement has come from operational efficiencies, which includes, let's say, reduction in repeat rates, reduction in wastages. Second part of the gross margin improvement is procurement savings. Because of the overmargins, we are able to negotiate harder with our vendors. And the third is the favorable product mix. So all these three factors have contributed for the improvement in gross margin, and which is quarter sustainable.
Okay, thank you.
Thank you. Our next question comes from the line of Krishna Raj K. from Equity Wealth Management Private Limited. Please go ahead.
Hi, am I audible?
Sir, you are audible.
Yes.
You may proceed.
Thanks for the opportunity. I just wanted to know why would be our revenue per test and revenue per patient is considerably low. I know we operate in a B2B model, but is there any chance of improvement?
See, the revenue per patient has grown largely because of the tests per patient, right? Not because of price increase. And that is because we have been adding more and more profiles, Janch, and all the other new initiatives effectively help a patient comprehensively test when they are feeling well versus unwell, versus, doing sporadic testing. So to that extent, the test per patient has gone up. But our mission statement is to make good quality diagnostics affordable to all. So we typically try not to increase prices and pass that on to the customer. We do our best to maintain the affordability to the customer because we believe that is our duty and our mission. For example, when the GST changes happened, we were the first company to pass on the entire GST benefits to our franchisees and partners.
Okay, got it. And the second question would be, so would we happen to see more volume in for the likes of GLP-1 weight loss drugs going off patent next year? Is it some opportunity for diagnostics industry? I wanted to know your views on this.
I thank you for that question. I genuinely believe that is going to be a huge opportunity. For those who know my profile, I've spent almost 20 years in the healthcare industry. I have never seen a molecule or a brand reach 100 crores in such a short period of time. And obviously, when it comes to weight loss drugs, it has to be taken with caution and with regular testing to ensure that while you're losing weight, your health parameters are all on track. So we are also in the process of launching complementary packages with the GLP-1 therapy, both pre-therapy, during therapy, and post-therapy, so that as you get on these weight loss, drugs, you preserve your health along with the weight loss. So it's a huge opportunity. Thank you for calling it out.
That's it from my side. Thank you and all the best.
Thank you. Our next question comes from the line of Harsh Kataria from RRR Investment. Please go ahead.
Hello, sir. Good evening. So my first question is, sir, I want you to throw some light on the revenue mix based on the online and the offline channel, specifically including the Thyrocare app and the Palm Easy platform. Because as you mentioned, there is 36% growth year on year from the Palm Easy. So can you please share the revenue mix based on the online and offline platform?
Sure. So a large part, the way you can think about it is our franchisee business is largely represented of our offline revenue mix, right? That you have seen has grown about 20%. The partnerships business you can actually take as representative of the online revenue mix. That has grown at about 36% for overall and for API as well. So those are the best bellwethers. Thyrocare is wonderfully placed because we have our leg in online and offline, and we get benefits of tailwinds in both. But to answer your question specifically, offline would be 20%, online would be 35%.
Okay. And mostly I checked too that the prices of the same plans are different at both the platforms. That is the Palm Easy and the Thyrocare app. So is the lower prices of one affecting the volumes from the other app?
See, the prices now, I think, if I look at most online players, when it comes to pricing, they have become quite rational. So, what used to be a very marked price differential maybe 1.5, 2 years ago is now more or less in the same range. That being said, Thyrocare being primarily a B2B player, we don't dictate how our partners price, right? So in that way, I have no control on the pricing on that front. But our offline players, typically look at the Thyrocare rate on the website and then use that as a benchmark. So it's actually very difficult for us to discount the Thyrocare website because that creates competition for our offline players. So we don't actually compete in this health tech. We would much rather partner in that space.
Okay, sir. That's it from my side. Thank you.
Thank you. We have our next question from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Thank you for the opportunity. I have a few questions.
First, starting with the B2G business. So you said we execute PV projects under the B2G business. Can you quantify the number, like how much of the top line comes from the B2G? And on that note also, recently there has been a price hike with respect to the CGHS rate. So will this provide us any traction going forward with the B2G businesses?
So I would say B2G is not a very large focus for us. So if you look at our overall revenue mix, I think it's about 1% of our total revenue. Last quarter, we would have done about 2 crores of government business in the 200 crores of revenue that we showed. So it's not a very large focus area for us, except in very specialized technologies like TB and others that we look at. The price realizations in the B2G business tend to be much, much lower and margin diluted for us as a company. So unless it's a very specialized segment, we normally don't participate in that segment.
Okay. So basically the CGHS rate hike will not be any impact on the business operations, right?
Not to a large extent, though it does, as they raise the prices, everyone raises the prices. So to that extent, there will be some tailwinds, but, I don't see any meaningful impact for us.
Mm-hmm. And so my second question is with respect to the GLP-1 drugs. So there is a new wave with respect to the preventive care and wellness segment. Can you, and the company also grew 19% during the quarter with respect to its wellness segment. Can you give any guidance or, the market opportunity which Thyrocare can aim for going forward?
Sure. I just answered this question with the previous participant. I will just say, in summary, the opportunity with GLP-1 for diagnostics is huge, and we are well geared up for it.
So this mid-teen volume growth, we are comfortably doing mid-teens volume growth every quarter, and with the GLP one coming into action in the coming quarters, I'm assuming our volume growth will be much higher. So can we expect a high teen volume growth going forward, like in FY27, 28?
Difficult to say at this point in time. It's still very early days for GLP-1. So I think when it comes to guidance, probably closer to the end of the year is when we will firm up our guidance for next year. It's too early to say at this point.
And sir, okay.
Sorry to interrupt, sir. We request you to please rejoin the question queue if you have further questions. Thank you. Our next question comes from the line of Siddhant K, an individual investor. Please go ahead.
Yeah, thank you, sir, for the follow-up question. Sir, like you mentioned, the only differentiator between the partnership and franchise model is online and offline, or is there something else as well?
No, I just said it is representative of the growth rates of offline and online. They are otherwise very different businesses. But what is your question?
So what categorizes as a partnership versus a franchise? So just wanted to understand the difference between how we categorize a franchise versus a partnership.
So a franchise is when someone walks into a store or contacts a Thyrocare franchisee for home collection. A partnership is where the partner doesn't have a storefront or broadly a storefront and relies on Thyrocare to complete the entire phlebotomy collection as well as reporting. So that's the difference. It's basically a franchisee does the collection himself. Our partnerships rely on Thyrocare to do the collection. Our partnerships are of three major types. There's health tech, of which Pharmacy, as I mentioned earlier, is a very large health tech partner. But equivalent to Pharmacy, we have as many other health tech partners. Then our corporate segment and our insurance segment comprises mostly the partnerships.
Got it, sir. So that means that the franchise model can have both our own brand as well as non-branded partners, franchise models also.
The franchise business can have both branded and non-branded. Partnerships can also be branded and non-branded.
Got it, sir. Got it. Thank you, sir.
Thank you. Ladies and gentlemen, in order that the management is able to address questions from all participants in the queue, we request you to please restrict yourselves to 2 questions only. You may rejoin the queue if you have further questions. Our next question comes from the line of Abdul Qadir Puranwala from ICICI Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on good set of numbers. So my first question is for the quarter, what would be our organic growth, that is excluding Polo, Vimta and Think? How would the business have grown?
So our inorganic growth contribution is 2%. So of 24%, 22% is organic and 2% is inorganic.
Understood. And sir, if I look at your presentation, it talks about we having close to, say, 38 labs now, and we have added a couple of that in this quarter and the prior quarter as well. So have we also closed a couple of labs? And if you could help us understand, why would we do that as compared to last quarter?
I'll ask Vikram.
No, we have not closed any labs. In last quarter, we reported 39 labs. What Rahul mentioned in its opening remarks that we are integrating Pogo and Vimta labs into our labs. So we have integrated 2 of Pogo labs into our network, and hence you are seeing a reduction in count.
Got it.
Hope this answers.
Yes, sir, that clarifies. Thank you. And sir, just one follow-up on the GLP-1 packages. So, sir, could you also help us understand, how the strategy is going to be, whether we associate ourselves directly to the hospital clinics which are already, our franchisee, or, this is going to directly reach out to the pharma companies? How exactly we are going to work here?
See, that is a matter of internal strategy. If I reveal everything on the call, my competitors will get a leg up. So I would request we keep it close to our chest. All I can say is that we have recognized the opportunity and are executing towards it.
Understood, sir. And sir, just one bookkeeping question. Then on the margin front, this quarter we saw a significant improvement. And so how should we look at for the rest of the year, that is the second half and next year, and on an adjusted basis or on a reported, whatever you're comfortable sharing?
See, this is a seasonal business. Q2 is always strong. Q3 tends to be soft. Costs remain fixed, right? And then Q4 tends to be strong again, and we'll recover. So I think we can expect margin, to dip a bit in Q3 and pick up in Q4. I think H1 to H2 will be similar, unless some large investment opportunity comes our way, in which we'll then stick to our original guidance. But otherwise, H1 to H2, one can expect similar range, unless some, as I said, large investment opportunity comes our way.
Sure, sir. Understood. Thank you.
Thank you. We have Sudarshan Agarwal from Axis Capital with the next question. Please go ahead.
Yeah, hi. I think my last question on margins was already answered. Just on the top line front as well, I think we had called out earlier that, S2 base is strong, so we are expecting mid-teens. Would that guidance continue for FY26? And my second question is, I think your annual increments are still to be done for this year, or, in which quarter do you take annual increments?
When you say salary increments, are you talking about price?
Yeah. Salary increments. And if you can answer the additional question. Yeah. Okay.
So from 1st April, we do the increments. That was done in 1st April. With regards to, the second half guidance, my general philosophy in life is plan for the worst, hope for the best. All that you have said still holds true. We are sitting on a very large base in H2. We have our work cut out for us. The current performance is very encouraging, but as I said in my opening comments also, fever was down quite substantially versus the last year. And, October, November, December tends to be the peak time for fever. So multiple headwinds, I'd say at this point, I would be hesitant to revise guidance. And let's see as the next quarters evolve.
Yeah, got it. And lastly, just one.
The current participant seems to have dropped from the queue, sir. We will proceed to the next participant. Our next question, it comes from the line of Anshul from MK. Please go ahead.
Hi, thank you for the opportunity. My first question is sort of a clarification required. Could you help me understand what explains the 10.7 tests per patient that we conduct? This number seems higher versus other B2C operators at least. Is this because of bundling, wellness, or anything that you can call out?
You're right. It's largely because of bundling. See, our highest selling Arogyam package is Arogyam C, which has about 70 tests per patient, right? And that, as I said in the opening comments, is close to about 33% of my revenue. So a large part of that test per patient is explained from the packages, both Arogyam as well as Janch.
Got it. Second question is, you mentioned that, pricing has become rational on the online front. And despite that, our partnership business seems to be outstripping franchisee business. Are you seeing any shift in customer preference, or was this probably some seasonality due to heavy monsoons in the current quarter that online players sort of got a leg up, or anything that you would want to call out in terms of customer preference from offline to online testing?
That's a very good question. It will maybe take me a couple of minutes to help you break it up, right? If I look at my offline business, right, a large part of the growth comes from tier 2 markets and beyond, right? Actually, if you look at the metro market, I would say growth would be in the single digits, but as you go outside the metros is where you start to see the real uptick in growth in the offline space, right? On the partnership side, which is mostly online players, most of them are metro and tier 1 city predominant, right? And so you would see them expanding and taking share in the metro market. So if I had to break out the growth, right, online players, largely metro and maybe a few tier 1 cities, right, where the growth even in offline tends to be muted. But as soon as you leave the metro and I would say select tier 1 cities, then the growth is in offline is much stronger because online is has not yet reached that level of penetration.
Thank you. Our next question is from the line of Yogesh Soni from InCred. Please go ahead.
Thanks for the opportunity, sir. My first question is just to get a clarity on the GST impact. Did you say that we have passed on complete GST impact to the franchisees? That means the prices for them have been revised downwards?
That is correct.
Second question is just if you would like to discuss more on your expansion of the field force and the investments or infrastructure that you are doing on logistics front, investments that you are doing on the logistics.
Sorry, I could not follow the question.
Can you help us understand, what kind of expansion you are doing in the overall field force? What is the quantum of expansion that has been happening, and what kind of investments are we making in the logistics front?
Sure. Just to answer your question, we have passed on the GST benefit, but we have also got the GST benefit, so effectively margins are expected to be stable. Right, so that's just one important clarification. On the investments, we have a field team. That field team is I think about 40 people right now, and we have a call center team of another 50 odd people. So it's almost 100 people that have been invested in franchisee expansion, and on average they're adding between 100 to 150 net franchisees every month, and they have been doing consistently, I would say, for almost the last 12 to 18 months. So that is going very well for us. On the logistics front, we have invested very heavily in cold chain. Now, every sample transportation box in Thyrocare has a data logger where we are able to track the end-to-end adherence to the cold chain, not just at the start point and the end point, but actually across the entire transportation. We believe we are the first diagnostics chain nationally to be able to achieve this milestone. And that has yielded a lot of good results in terms of our cancellations, our ability to report more accurately, as well as customer satisfaction. On the other front, we continue to expand labs and improve our turnaround time. It used to be almost 40 hours plus. We are now down to 18 hours or less pan-India. And so that has yielded good results for us. And I think those are the large investments we're making.
Got it, sir. If I can ask one more question on the radiology front. A couple of quarters we had in the past, you had told that you weren't expecting to grow radiology business to grow. Have we seen any change in stance on the radiology business, given the margins have improved in the business?
Yeah, maybe Vikram can add, but the radiology business last year was loss-making, right, and a drag on our overall bottom line. So we said, let's forego unprofitable growth and let's at least focus on ensuring these businesses are contributing to the bottom line. In that, Vikram can elaborate a little bit more on what exactly we have done there.
Yeah. So this quarter, radiology growth on our active centers was 3%. This excludes because we have closed one non-profitable center and taken some action on there was some temporary halt in one or two centers because of the issues which we get again started in 20 quarters. But having said that, as Rahul mentioned, that we have foregone the non-profitable growth and we have increased over realization per scan. So that goodness will continue to come, and with all the centers fully operational in the OND quarter, we expect revenue growth to also come back in the next quarter.
That answers my question. Thank you, sir.
Thank you. Our next question comes from the line of Raman KV from Sequent Investment. Please go ahead.
Thank you, sir. All my questions have been answered.
Thank you. We have our next question from the line of Abdul Qadir Puranwala from ICICI Securities. Please go ahead.
Yeah, hi, sir. Thank you for the follow-up. Sir, could you help us quantify the quantum of or the overall contribution of the test on which there was a GST cut taken? And, when we talked about earlier that the CGHS rate hike can, lead the industry to increase test prices. So, what percentage of our portfolio would overlap there? These two quantification if possible.
So I'll take the CGHS question. I'll let Vikram take the GST question. See, CGHS, there's no specific test that we have in our menu that is exclusive to CGHS or vice versa. What gets written as a prescription in CGHS, almost all those tests are there in Thyrocare. There's no such overlap. If you are asking how much of our business is CGHS based, it's very little. You can say negligible overall. So to that extent, we won't see a benefit on our overall business because of CGHS rates. But what I was saying is as CGHS increases its rate, the competitive pressures in the industry also ease off, right? And therefore, there is some benefit on that front. Vikram, you want to take the GST question?
On the GST rate cut, basically, there was a GST rate change as an input only on the couple of technologies. So most of the other technologies which we are using are already on a 5% GST as an input. So if I have to quantify close to 20% of the total input which we are purchasing, there was a GST rate change, which was majorly biochemistry related test. So there we have, in the biochemistry related test, we have reduced the prices, which we have passed on to B2C and B2B purchase.
Okay, so what was the contribution to revenue of this biochemistry test?
This would be close to, I think that's the same 20% of revenue. Same 20 to 25% of revenue.
Understood, sir. And thanks for that. And just one.
You should also understand that. At the same time, you should also understand that this is 20-25% of the revenue, where there is a GST rate cut on the input prices, and since our COGS is 30%, let's say, so the benefit would be 30% on that 30%, right?
Sure.
So it would be a 0.9% on that 20% or 25%. So that way the benefit was very negligible. But whatever is the benefit that we have passed on those selected tests.
Sure, sir. Understood. And sir, one final one, if I may. Sir, on margins. So in the last couple of quarters, we have been opening new laboratories. So is there any EBITDA burnout which is happening there? And if you could call out, what is the impact of these new centers on your margins currently?
So see, we have a very limited lab network, right, of roughly 39 labs, as we said. And so therefore we service a very large area of the country. And we are able to see where demand is coming from and accordingly take decisions on setting up labs. For example, in Bhagalpur, we knew already the workload that was coming from Bhagalpur to our Patna lab. So when we set up Bhagalpur on day one, it was full, right? So there was no real OPEX dilution or no material OPEX dilution and a much better service level to the customers in Bhagalpur. So our lab expansion is very thought through with data where we are able to see where the demand is coming from to one of our, let's say, existing labs and then invest accordingly.
Got it, sir. Thank you.
Thank you. As we have no further questions from the participants, I would now like to hand the conference over to Mr. Rahul Guha for closing comments. Over to you, sir.
Thank you. Thank you, everyone, for joining us and spending the time with us this evening. As always, we continue to remain focused on our strategy which is to be the most affordable, good quality diagnostic center testing partner for anyone in the healthcare business, and we continue to execute on that strategy. We have been investing in improving our quality, improving our reach, and ensuring our turnaround time is as close to best in class. And we've made substantial progress on all of this, and that is what is driving the results that you see. I thank you all for your support in this journey, and I wish you all a good evening and a very happy Diwali in advance. Thank you.
Thank you. On behalf of Thyrocare Technologies Ltd, that concludes this conference. Thank you all for joining us. You may now disconnect your line.